now coming up, I would like to invite our next speaker of the day, Mr. Mitesh Shah. He's co-founder IP Ventures. The topic is why now is the right time for angel investing. In the post-lunch session, it would be immense pleasure to begin the proceedings by inviting Mr. Mitesh Shah to deliver his presentation on why now is the right time for angel investing. Given the kind of industry-wide interest in areas like in angel investing, there could not have a better opportunity moment to talk about this angel investing. I invite Mr. Mitesh Shah on the stage, please. Mr. Mitesh, co-founder, IP Ventures. The topic of the presentation is why now is the right time for angel investing. Welcome, Mr. Mitesh.
Good afternoon and welcome to this introduction session with IPV. I know after lunch, it will be difficult for me to hold investors' attention, but I think this is something that is very interesting. As we all know, with Shark Tank, startup investment has become so popular. And we have been doing this Shark Tank in real life that we have been doing since almost now 5 years. And I'm here to kind of take you through some of our experiences and some of the nuances of startup investment, right? I think it's a very, very deep subject, and there is a lot to learn apart from being a great investment avenue as well. A quick introduction about myself. I started my journey as an angel investor almost 8 years ago when I did my first investment in 2015. Was CFO with Ola, so was instrumental in seeing Ola journey from a Series A company to Series D company, from almost a 25 million valuation to about 6 billion in valuation, and one of the top 3 startups in the country. And that was my first stint with digital businesses. My understanding about internet businesses improved exponentially in my journey with Ola. Joined Book My Show as CFO then, another large, consumer-facing B2C platform. Today, all of us kind of use Book My Show for our movie booking, right? And Ola is also kind of synonymous to mobility, in the country. So, have had the pleasure and the opportunity to work with these 2 large brands, and that's where I got my understanding about how a startup can actually make difference to a consumer's life, not to forget the investor's life as well, and the founder also. So started my journey in 2015. Was largely individually investing into startups with small check. Around 2018, a few of us like-minded people came together and set up IPV, where the idea was to democratize angel investment. Together as a group of CXOs, we are India's largest angel investment platform today, with an angel fund which is almost $50 million plus in size, having invested across 150 plus startups. I have individually invested in about 100 plus startup now, and was also ranked 32nd most active angel on the list of top 100 angels by Fortune India. So I think, like I said, it's the learning part which has really kind of glued me to this world. And learning continues even today, as you all will have a lot of questions around how do you value startup? Are startups for real? Are the valuations for real in the wake of some of the recent debacles on the public market as well? So I would like to make this session interactive. If there are any questions, please feel free to ask me. Right. I think so. This is where we all kind of look into startup investment as a general topic. As the great Warren Buffett said, every decade or so, dark clouds will fill the economic skies and they will briefly rain gold. So this is where, as he also said, that where there is, others are fearful, I'm greedy. When others are greedy, I'm fearful. So I think something similar today when people say that, okay, startup investment is very risky, we really sense an opportunity over here. I think there is a great opportunity in identifying some good investment opportunities coming in at early stage. It's just about helping them. It's just about working with them closely. And that's what IPV today stands for, when we work with startups. Typically, I would just like to ask a question to the investors. What do you think is the success ratio for startup? When you invest into early stage startup, what is an ideal success ratio? 10%, people say 10%. 40%. 5 or 50? 5%, yeah. Yeah, so I think the general perception is that when you invest early stage into a startup, right, the success ratio is that the startup invest karoge, 2 will succeed probably, and the other 3 may return your capital and other 5 will go bust. With IPV, proud to say that out of 145 investments that we have done so far, 22 have secured a profitable exit, an exit above 150% IRR, and almost 44 have gone on to secure next round of funding. So here the success rate is about 50%. That's purely because the kind of method that we follow, the kind of process that we follow in curating startups before we kind of decide to invest into it, rather than going with the herd mentality where you are just simply investing into startup. And that is called spray and pray. You just say that, okay, I will invest into 50 startups and then pray that, okay, at least 5% of that should kind of be successful to get me those returns. So without going into the data, I think there is no dispute about, the promise that India holds as a market, as a good investment avenue, be it public markets, be it bond markets, be it startup investment. I think some of the macroeconomic factors which is driving this investment, and more on the VC side as well, as we've all seen the growth of startups also in last 5 years or last 10 years, so to say, is largely because of the number of internet users that's increasing in the country and the data consumption. And, we all know the contribution that Jio had to this journey. But generally, I think the rural penetration, in fact, rural India is growing faster than urban India in terms of internet users, mobile penetration, data consumption, and a lot of other metrics. So that's where the real consumption power comes from, and that's provide kind of a great opportunity for not only a lot of D2C brands or B2C businesses, but B2B businesses as well. Right? Again, I would like you to focus on, India currently ranks third in the unicorn race, while US has seen almost 800 plus unicorn, China has seen 200, India is at 107. Now, out of these 107, actually 50% were created in last 1 year alone, or last 1.5 year alone. And that's how the growth has been in last 1.5 year for the startup ecosystem overall. And that's because a lot of new capital flowing in, a lot of angel investors like us have been supporting startup at early stage. And not to even forget the government initiatives that's supporting startups in a big way, right? And 2x unicorn added in 2021, as I said, compared to China. And if you look at the speed of the unicorn creation now, if you look at the speed of wealth creation, look at the last chart. Flipkart actually took 6 years from inception to become a unicorn. Then we got a herd of startups like Swiggy, MPL, BharatPay, Rivigo, right? CoinDCX, which became unicorn in like 4 years. Then came Apna and Cred, a new breed which kind of got to unicorn status in 3 years. And now we have startups like Mensa, which is a famous house of brands, became unicorn in like 6 months. Yeah, Ola Electric became unicorn in like 2 years. Now, I'll not like to comment about the valuation of some of these, but I think the idea is that the scalability and the speed at which these startups are growing and becoming an important part of consumer's life or a founder's life, that's where a large part of this growth is coming from, and value creation is happening very, very fast. Again, some very, very interesting number, right? Growth stage startup, maturing, moderation, renewed optimism. This is the timeline chart from 2012 to 2021. If you see the last line, which is average deal size, from a 6.75 million on an average, the deal size actually went up to almost 26.5 million in 2021. Now, mind you, 2021 was a great year for startup ecosystem overall, and 2022, as a lot of you, even being public market investor, would have heard of funding winter, right? So what we call it is funding winter, which is there has been some amount of slowdown in the funding, at least for the late stage startups. As early stage investors, we look at this and we cite an opportunity over here and get hold of a lot of these great ideas, great founding teams, early stage to invest into them. So funding continues to, like I was just talking about, this is the chart, for the current year from January to September. As you see, there is a downward trend in terms of, falling funding. There are a lot of these startups where, funding crunch is leading to layoffs. Now, I think part of these layoffs are also because startups want to get back to a more fitter health and kind of, preparing themselves for the funding winter, so to say, and preparing early rather than going till the last stage, waiting for the funding. But I think we have seen a few debacles over here. We have seen a few large startups also destructing huge amount of wealth. But generally, if you see, I think still it's a great ecosystem for the sheer value add they drive to the economy. Not talking only about valuation, but the sheer amount of job that we are able to create, the problem statement that we are solving. It's a very, very robust market. Right. Now, I'll compare this with, some of the great ideas that were created during the recessionary crisis. So we have largely seen probably in an average investor's lifespan, we have seen three major meltdowns. So the economic downturn of 1970, Microsoft, which was founded in 1975, Apple and Microsoft both were born in this great recession in 1975, 1976. Then came the dot-com crash of 2000, where we saw startups like SpaceX, Google, Baidu, MySQL actually coming. And you see the numbers, like these are mouth-watering numbers. They raised, 5 million, 2 million, 10 million, 11.2 million sort of funding during this time and were available at mouth-watering valuation, right? So this is all about identifying these winners early and then participating in their growth journey. So wherever you feel like chips are down, this is a recessionary time, probably it's never going to recover, that's when a large unicorn, a large opportunity is actually born. And the financial crisis of 2007-8, we saw a lot of such unicorn startups, high-value startups actually taking birth in US. So a lot of these names will be familiar: Airbnb, WhatsApp, Evernote, Uber, Spotify, Glassdoor, Dropbox. All of them were born actually precisely during these 2 to 3 years of 2007 to 2009, and we all know where they are today, right? I just mentioned this last line where it talks about be greedy when others are fearful and be fearful when others are greedy. So without going into detail again, I think the whole premise with which we work is that for every recession, right, there is a boom period which kind of succeeds it, and every recession is also preceded by a boom period. So I think it's volatility, it's this cycle that we continue to kind of work on and go well. So these few slides are about the dry powder which is there, in the pipeline. A lot of VCs have already raised good amount of funds, and there is, in terms of liquidity, there is enough liquidity in the ecosystem. It's just waiting to be deployed in right value of startups. Talking about IPV, like I said, we have been active. The idea was born around end of 2018. Today we stand as, largest ecosystem. So what started as a platform approach with a few CFOs like me coming together, today we have a bunch of 7,500 plus investors on our platform, which collectively kind of drive the decision making. These investors are also part of, the startup curation panel where we select new ideas. These investors not only invest and work with the startup founders, but also help them connect to other like-minded investors, large VCs, work with them closely as experts and drive growth story for them. As a result, the numbers that I spoke about, that out of 140 startups, right, 50% of the startups have given exits or partial exit at an average IRR of 135%. Now, these are real numbers based on the actual experience or actual investment data that we have, right? And few of the names that probably you as consumer will also kind of relate to. Fable, one of the largest startup in India when it comes to health tech. Videoverse, an AI meta tagging platform, which went on to become a large startup in US. They flipped to US. BlueSmart, a very famous mobility story, born out of Delhi, giving a run for its money to even Ola and Uber and growing rapidly. Samosa Party, a QSR startup. OTP, a farm to fresh, grocery tech startup. So there are lots of such in our portfolio which have gone on to create multiple, of IRR for investors and have got some great returns. So to the contrary to the public opinion which we just heard that the startup success rate is about 10%, with IPV, you not only kind of gain because the startup success rate today is 50%, but also the amount of knowledge that you generate, right? I think the biggest problem with the ecosystem today is that there is a lot of mis-selling that is happening in the name of startups. Why you should invest? You should invest because a general super investor is also investing in that startup, or startup is founded by an IIT or IIM founder, right? These are all misnomers. We try and kind of clarify that, clear that with our understanding and with our detailed due diligence about the actual value that the startup is able to create and drive. Right. So I think in terms of asset class, if I were to talk about, this is the general return that a particular asset class will generate. Anything ranging from, in the degree of, as we say, SLR, safety, liquidity, and then returns. With highest safety comes lower returns, and with higher returns come probably low safety or moderate safety. Startups, I must admit, as an asset class is high return, high risk. So people need to exercise their own discretion before choosing this as an asset class. But if you do it persistently, like the thumb rule that we always say is that when you invest in 5 startups, chances are that you might lose your capital also. But when you invest in 10 startup, you will always and always recover your capital, because that the rule of probability also will play, and you or yourself will become much smarter and much choosier when it comes to selecting great ideas. When you invest across 20 plus startup, that's when actually the returns start coming in, and it will definitely beat any of the other asset class return that you would see. And this is not only IPV data, this is the data for industry overall, right? So if you look at overall in terms of the wealth creation, 100 rupee in asset tax deducted at source, these are the sort of returns that it generally will generate. Real estate will generate an IRR of about 9.2. Equity will generate an IRR of about 36.4, right? Angel investing in as an asset class, the overall IRR that it has generated is always in excess of 20%, right? And that's how it's kind of driving. Just 2 minutes. Why angel investing group is better? Because I think that's where our collective exercise comes into play. I have my experience as a good B2C story working with Ola, before that being human, and then Book My Show also. But there might be a lot of experts in our group who are B2B experts, who are able to understand businesses which are on the enterprise tech side, health tech side. Collectively, we are able to kind of generate good amount of knowledge for ourselves when it comes to evaluating a startup, and also help the startup in its growth journey. Also help it open doors, connect dots, connect with large VCs who can help them for next round of funding and the future growth of the startups. So that's what IPV is all about, Inflection Point Venture. We are not only a platform, but we have 2 VCs funds now, which is First Port Capital, which is our Angel AIF, where we look at investing across pre-series seed stage to pre-series A sort of ideas. Investment ranging anywhere from a minimum of 100K going up to $1 million, right? With an average capital deployed per startup of about $500,000. So across 145 plus startups that we have invested across, the average capital deployed is about 500 CR. And we continue to do almost 60 to 70 new investments every year. So every month, we'll look at close to 500 new ideas. And after 4 layers of filtering, finally end up investing in about 5 of them with the help of experts or industry veterans like you as well. So this is the funnel that I was just talking about, less than 2% funding rate, right? From 7,600 funding requests received so far in last 3 years, we have funded only about 1.5 to 1.75%, which is about 145 startups. This is the overall life cycle for the startup. Knowing the startup, deep due diligence, informing investors about the diligence, finalizing the investment construct. This is also very, very important when it comes to negotiating the investment documents, right? Call for money sent to the startup, post-investment. This is where most of the investors are not able to help startup. Startup investments are being looked as a transactional approach, that you just invest into the startup and let the founder do all the hard work and generate wealth for you. Contrary to that, we as a group are able to work closely with the founder and influence the outcome also, rather than depending on luck. This is a critical scorecard that we prepare for ourselves while we evaluate any startup opportunity for investment, and this helps us take an objective decision rather than just going by intuition or going by gut feeling. Right? Some of the critical numbers, join 7,500 plus angel investors as part of the journey, consistently delivering very high value. So far, our average IRR has been 170%. And the beauty of the platform, contrary to the belief that startup investment is only for rich people, we are saying that come invest with us with as low as 2.5 lakh rupee per startup. For us, the investment journey start as low as 2.5 lakh rupee per startup, and then you can build on from there, depending on your liquidity, depending on your disposable surplus wealth for startup, right, after the other asset classes. But like I said, once you put more than 20-25 investment, then I think success overall at a portfolio level, success is always measured at a slate level for the portfolio, be it any market. Here also, success definitely follows if you invest through the right sources and invest with the right thesis in mind. So this is what the Angel platform, which is a platform for individual angel investors. First Port Venture, which is our Angel AIF, right? It's a category 1 SEBI approved Angel AIF. And 5 Capital, which is our new VC fund, where we'll be looking to take bet across Series A, Series B startup, what we call growth stage ideas. The minimum investment here will be 1 CR as mandated by SEBI for AIFs. For First Port Capital, which is the Angel AIF, the minimum ticket size is 25 lakh rupee, which is a commitment that you need to invest across 5 years. Right? We don't stop playing because we grow old. We grow old because we stop playing. This is the saying that we live by. I think every day is a new day, an exciting day for us as we look at new ideas and we don't stop growing with that. Thank you. Thank you. With that, thank you so much for a patient hearing. Would love to kind of have any questions if you have. Would love to kind of take a couple of questions if we have time for this. Sure.
Sir, how can we decide that market or particular stock will run from here or not? As we have seen Shanghai Chinese market, okay? In 2005, Chinese GDP is very low compared to US GDP. And right now, Chinese and US GDP almost running parallel, even though Dow Jones is running at lifetime high, right? And Chinese market is near about 2008 lows. So even though highest GDP in the world, Chinese market is not performing since last. Same way we have seen in 1992, okay, HPCL, BPCL, and pharma stocks were performing. After that, okay, after that crash, till 2012-13, these all stocks not performing. After 2011-12, pharma stock and HPCL, BPCL start performing. So how can we know well in advance that this particular sector, this particular index will start performing?
Well, great question, and I like to answer this from a startup perspective, right? Luckily, and that's the major advantage for startup world is that, in a sector, you can have, for a bad sector also, you can have an outstanding player. And for a great sector, like we saw edutech during COVID, everybody felt that kids will never go back to school. I think edutech startups are the only way to invest, right? But things change, right? World is very, very dynamic. E-pharmacy, right? Delivery of pharmacy at home was actually considered illegal by Supreme Court verdict. And then during COVID, I think that was the only way that we could procure medicines and all. And pharmacies of the world were actually born during that time. So I think it's about taking a call on an individual startup basis, individual story, backing the founder. Founding team actually makes about 60% of our decision at the stage at which we invest. And that's where I think it's great learning. So to answer your question, I think no sector is bad. No sector is so good that you can ignore it completely, right? So it's about balancing out your portfolio, looking at right founding team, looking at right valuation, and investing in the right idea.
Thank you, sir. Thank you.
Mike, please, there. I've been instructed this is the last question I can take, so I can make it quick.
Hello. Yeah, my question is why do most of the startups are chasing valuations instead of making a sustainable and creative brand for the consumers?
That's a very, very good question. I'm glad that you asked, and that's where actually I think we segregate men from boys. I think it's not a T20 game. It's not a short-term race. It's not a short-term sprint. While obviously everybody likes to run fast and take that initial lead, but ultimately you have to believe that you are here for the long term, right? And that's where I think sustainability is very important. That times like today actually teaches that to founder. When capital is little bit difficult to come by, right? But great ideas still get funded. Great founders still get funded. As I showed in my presentation, VCs and investors like us are sitting on good amount of dry powder to always back good ideas, which are built with sustainability in mind, and not just kind of burning investor capital to build something which is not sustainable and not scalable. Thanks.
Thank you.
Yeah, hi Mitesh, and wonderful presentation, I must say. The
Thank you.
market returns of 144% definitely sparkles up. But just want to understand from perspective of a retail investor. Now we can see the startups IPO, what's going on. So definitely you have a great experience in this angel space. What about the IPO space? Any question on that?
Well, I think we truly believe that at some stage startups and normal businesses also converge. We have also seen a lot of startups going for IPO, this year and last year. Well, I'll not like to talk about the outcome, as we all know. But I think these are discovery times. These are times where we kind of discover sustainable business model, like the gentleman asked, right? And the valuation will also kind of find a way for itself. As the startups also now realize that probably you have to leave something on the table for the investor itself. And at the end of the day, it's all about, generating cash flows, right? It is very, very important that, as we all say, top line is vanity, bottom line is sanity, but cash flow is reality. Ultimately, it's cash flow which kind of matters at the end of the day. And that's what I think investors and startup founders also have to understand. Thank you. Thanks, everyone. You have been a great audience. I'm available offline to chat with you. Thank you all. Thanks.